So this feels like a period of consolidating expectations from the market at the moment. How do you navigate the uncertainty?
Good morning. Thanks for having me. Well, quite clearly, it's $1 million question. We're trying to navigate by looking for anything that's more predictive in a relative sense. So overweight to US dollar earnings. The US economy, despite the unforgiving sell-off of risk assets year to date, it actually is more predictive from the monetary policy sense, the fiscal policy setting, notwithstanding the energy stability relative to other continents and economies around the world, credit conditions more stable relative to Europe, and equity earnings to be confirmed from the reporting period this week. So broadly, more predictive characteristics make the US economy and US dollar earnings a little bit better to have in your portfolio. But without a doubt, the US Federal Reserve will continue to create additional demand destruction, create slack in the economy. That equals pain. And that's what we're all trying to second guess. Valuations are reasonable, but they need to obviously deliver more weakness to the labour market and to the credit numbers that are still growing at a softer pace, but they're still positive, and they're trying to unleash that slowdown, as Larry Summers keeps saying, to deal with not just headline, but core inflation, which will be problematic getting it down.
Yeah, you say the valuations are reasonable, George, but are they low enough in terms of where expectations might be set for this season?
Well, they're low enough for us to say don't go underweight equities here. S&P 500 in general. The energy thematic seems to be reasonable overweight. Good quality companies that are spinning off good cash flow. High discount rates are the headwind for valuations for obvious reasons. So growth at any price won't work. But some value and some growth at reasonable price. Again, it's how you position a portfolio. But as we're doing that, be cognizant that it's all about macro. It'll be macro drivers, geopolitical drivers, headlines that will be dominating and creating those periods of excess volatility between now and sometime next year. Understand something like the IMF numbers on Tuesday, obviously downgrades to global growth, and what does it look like going forward? So that's not going to go away. It's backward-looking data, but it's very hard to sort of second-guess where those future conditions will land. Notwithstanding, China's got an opportunity, even though it's got the biggest housing bubble in the world. It passed when they do party congress, there'd be more certainty, you would think, with their bureaucrats set for the next 5 years. Fiscal policy hopefully can talk to their stimulatory monetary policy. There's an opportunity there, but they're just risks in so many different places. And again, coming back to the Federal Reserve, they are delivering consistent to their word, and that is creating additional demand destruction to deal with inflation.
Is there a point where you're going to say it's time to buy long-term bonds? So many financial advisors and portfolio managers have said in sovereign fixed income, you want to be very short duration. We've seen big sell-offs in bond markets. Yields are a lot higher. Is there a point where you say, aha, time to move that trade from the short end to the long end?
Yeah, there is, and that's another great question. Sometime in the next 12 months, if you're looking for guidance, we take it from the short perspective. It's very short duration still in that 3 to 5 year part of the curve, senior unsecured. We think high yield is a replacement at this stage of the cycle because of the impairments increasing at the margin to equities as a risk asset class. Putting that aside, great value in that 3 to 5 year senior unsecured FRNs. But you are right, some form of extending duration. We're not quite there yet. And when you see that, that's a bit of a risk on. Look for those other predictive indicators for an increase, a slowdown that's increasing at an increasing rate. It's bad news, it's good news in a sense. And that is, we need more yield inversion for the 210s, for example, in the US, and to come through. But yes, I'd like to be thinking we'll be brave enough to extend duration sometime in the next 12 months. And I suspect that means it'll come earlier, late this year, early next year.
Sounds like there's no rush to make the move. But what about energy? You know, OPEC Plus cut output. It seems like a lot of advisors, portfolio managers are looking at energy in one form or another, whether it's crude or gas, as a good place to be.
Yeah. We'll park ourselves there, like many other active managers. And just to reinforce here, so OPEC's probably not a surprise they're going to cut. It just means that the US is going to really lift its efforts. It can never influence OPEC from the 70s onwards. We already know that. But it needs to lift its effort to reinforce energy security. And if I may have a quick backdrop on that, something like Woodside, and you've got many like Exxon, Chevron, globally, but something with LNG in your portfolio up to 50% of your portfolio in the case of Woodside, I'm just using it as an example, it is a key transition fuel for the developing, for 2030, 2040, 2050 targets, and the emerging world for the 2060, 2070. So for a good 50 years ahead, the key transition fuel is energy in LNG format, gas in some form, for the developing world. And that's why it works so well in the portfolio, strong cash earnings. So we see that as good medium to longer term. And obviously those companies that have got obviously petroleum revenue, like BHP's ex-petroleum revenues went over to Woodside. So I'm just using it as an example. It is a key area that's still got strong cash flow, still got good tailwinds, and will maintain that position with many other active fund managers as an FYI. But it is a key part of the transition for the emerging and developed world.
Something that's going to carry on for a while. And speaking of the emerging world, over the weekend, Bloomberg having a story about how a lot of emerging market assets are just about at the point where they're looking more attractive, that they have been beaten up, that they probably maybe bottomed, that there's some of the central banks have been successful in, attacking inflation and still allowing some growth. Or what do you think of that argument? And is there any emerging market you like?
Yeah, not quite there yet. A lot of damage for the US dollar strength that will continue into emerging market sovereign debt and corporate debt coming out of this period. Having said all of that, emerging markets is not all. You can't all bundle in one. We do like emerging Southeast Asia, so Indonesia, Malaysia, anything around Singapore is a good play. Emerging markets in parts of Central America and South America are good and also bad, depending on the economies and the transition and the change of governments and the less predictive nature of policy and energy security. And then emerging markets out of MENA seem to be a very strong transition into a big savings hub for the next 50 years. That's a good long term. And there's competition between Qatar, UAE, Oman and Saudi as they're changing those economies. I've just said a lot in that small period, but the point of the emerging markets, you've got to play it from regionals, different perspectives, from manufacturing in Southeast Asia and some financials, to savings and energy, obviously, in the MENA region, and a blend in South America. And then it's always good value. It just means it'll be probably better value going forward, similar to what the German economy is like in German equity valuations. Every year for the last 5 years, they look like good value relative to the S&P 500. They'll just be better value going forward until, again, we get some certainty on US dollar weakness and a turnaround, and the Federal Reserve increasing at a decreasing rate. That's enough to create some stability in currency markets, which will filter down into other risk assets.